Good morning, everybody. I want to welcome you to the 11th Annual Finance Forum sponsored by Bellwether. And Sarah Berman and her team has assembled a great list of panelists for you today, so we're pretty excited about that. It's sponsored by Bellwether and also sponsored by our diamond sponsors. So I want to run through those real quick before we turn it over to our moderator, Mr. Lockard. So our diamond sponsors from the supplier side: Apartments.com, PPG, Sherwin-Williams, Court, Royal Finish, Contractors Inc., Callaway Cleaning and Restoration, and Pinnacle Paving. Those are our supplier partner diamond sponsors who have supported the GCNKAA, and we appreciate their support over the last several years. That's helped make this and other events possible. And then on the primary side, BRG, Town, Hills, Wallach, and Fath are the five of the primary sponsors as well. So I want to thank those five companies as well for their continued support. And then lastly, Patty Braun is on the screen here, and there's several people that I've noticed through going through the registry that aren't members of the GCNKAA. We do represent over 100,000 units in this area. We've got a great legislative team, member engagement, education. So definitely reach out to Patty about potential membership, whether you're on the supplier side or on the ownership side. So we'd really appreciate having you as part of our group and our association. And with that, I'd like to turn it over to Dave Lockard.
Thank you, Don. And good morning, everyone. So welcome to we were figuring out this, I think this is our 11th finance forum that began when Sarah and Mark cooked this up, and it was well received. So glad to have everyone here today in a little bit of a different environment versus Kenwood Country Club. So today we're going to introduce each of our panelists and ask them to give a little brief bio. Then we're going to go through a series of questions relative to what's happening in the lending market today. We'll also do a Q&A at the end. So how we're going to do Q&A, if you have a question you'd like to pose, you should see a chat bar at the bottom of your Zoom screen. Chat. We're going to do all of those at the end of the program. So there will be Q&A. So with that, good morning, everyone. By the way, this program is being recorded. If you object to being recorded, you should hang up right now. And let's introduce Sarah Berman from Bellwether. Many of you already know her. And Sarah, why don't you give us a little bit of background on yourself for the three people on the call that don't know you.
Okay, hi, good morning. I miss everybody. Dave put a slide up. Normally we do a little placemat that we put at everybody's table when we're at Kenwood having a delicious breakfast. But I just wanted to highlight a little bit about our team here in Cincinnati. Last year, despite COVID, we had a record year, unbelievable. We were all stunned. We did a lot of multifamily. As you can see, we did $734 million, and 82% of that was multifamily, split pretty evenly between the life companies and the agencies. One thing I want to point out that's sad to me is you'll see on the placemat, Elmer Cole is no longer pictured because he officially retired. My partner forever has retired, and he's so happy in California right now, but that's why he is not on the placemat. The one thing I talk about every year is I think Bellwether's so special because we really give back into the community. That's how we differentiate ourselves from other mortgage banking companies. From 2015 to 2019, we had a program called the BEST program, and we would donate on behalf of our best borrowers, most loyal borrowers, to the charity of their choice. And we gave away almost $950,000 in 4 years in that program. So this year, we decided in 2020, 2021 to pivot a little bit, and we want to become the leader in inclusion and diversity in the mortgage banking industry. So we formed a foundation, the Bellwether Foundation. Employees have donated over $200,000 into that foundation. And what we're going to do is give 10 $10,000 college scholarships to kids who want to major in real estate who otherwise wouldn't be able to go to college. So that's going to be our first endeavor, and we're going to hopefully be able to do that for the fall of this year. So Bellwether is just so special, and I just wanted to highlight that versus our normal course of business. And that's it. Most of you know me. I do a lot of multifamily, and I'm thrilled that so many attendees are on the call. And in advance, I want to thank our very esteemed panel this year. Okay, on to Griffin Cotter.
Thank you, Sarah. Appreciate it. This is my first year on the panel, so super excited, and thanks for having me. My name is Griffin Cotter. I lead the Central Region production team for Freddie Mac. That covers all the way from Ohio over to Texas and everything in between. We do about 16 billion annually is what we did last year, and we'll see where we finish in 2021, but aiming for probably a number in that ballpark as well. So a lot of loans, a lot of loans in Ohio. I'm actually grew up in Columbus, so I'm partial to Ohio. And we've been working with Sarah and the rest of the Bellwether team for a long time, and they're a great partner of ours. So really excited to be here.
Thank you, Griffin. Ann?
Hi, good morning, everyone. It's great to be with you again. A little different this year, but it's great to be back. I'm excited to be invited again to speak on the panel. I'm Ann Atkinson. I am with Fannie Mae. I'm based in Chicago. I've been at Fannie Mae for a little over 18 years now. Always have been in the multifamily space, and I manage a team that collectively my group manages 7 different DUS lenders, of which Bellwether is one. I also manage our small loan production nationwide. And I'm very excited to be here. Thanks.
Thanks, Ann. Don?
Good morning. I want to thank everybody for inviting me to participate on your panel. I would be remiss if I didn't say that after 41 years this September in the industry, I know almost every mortgage banking firm and mortgage banker, and I think most of the panelists would say we're only as effective as the people that we work with. And I'm going to pay Sarah the highest compliment that out of a handful of mortgage bankers that I would have represent me, she's one of them. So thank you. I represent Protective Life Insurance Company. We're headquartered in Birmingham, Alabama. What makes us a little unique is that we are a wholly owned subsidiary of Dai-ichi Life Insurance Company. Dai-ichi is one of the top 10 insurance companies in the world. We're based in Tokyo, listed on the Tokyo Stock Exchange. We serve 9 countries with about 69,000 employees. However, we are their footprint into North America and have a huge appetite for commercial mortgage loans, including apartments. Thank you.
Thanks, Don. And worth noting, by the way, that is not a virtual background behind Don. That is actually his real background. Not kidding. Zach Fisher.
Hi, thanks. So Zach Fisher, thank you guys for having me here. I work at Morgan Stanley, where I've been for the last 15 years. I run the CMBS conduit program for us at Morgan Stanley. So while I do maybe less percentage multifamily than everyone else here, it's still a reasonable volume. In conduit last year, we did roughly $3.5 billion, but we averaged between $3.5 billion to $4.5 billion of total conduit production any given year, about the same amount again in standalone. And then we have a balance sheet lending program as well. But thank you guys again for having me.
Thank you. So let's kick it off with our questions to our panelists. And we're going to begin with the questions directed to our agency representatives. We'll start with Ann, then go to Griffin. So Ann, I mean, let's talk volume cap. How has agency volume cap, how has this impacted your appetite for multifamily in 2021?
So, you know, last year was such an extraordinary year. I mean, as Sarah mentioned, Fannie Mae originated $76 billion worth of multifamily last year in 2020, which was an increase from the year before. We were just over 70 billion in 2019. So it really was an extraordinary year, despite all of the different challenges everybody faced. This year, FHFA has shared that the cap is $70 billion for both agencies. And, you know, having a cap is nothing new for us. We've actually had one, I think, since 2012. So whenever we get the updates from our regulator, we are very quick to respond. We're very quick to be able to make whatever changes are needed in our business strategy. And our lender partners have been with us every step of the way. So having changes in cap and cap requirements is nothing new to us. And we're prepared for it. We also have, in addition to our cap kind of compressing a little bit down to 70 billion for the year, FHFA has required that both agencies do at least 50% of our business being mission rich. So we've had to make some adjustments here and there, but nothing substantial in terms of, going forward. Multifamily is obviously very mission critical business. Our mission and our goal is to continue to provide liquidity and capital to the market and preserve affordable housing. So Griffin, I don't know if you have anything more to add. Sorry, Dave, I don't want to take over.
No, absolutely. Great information. Griffin, anything to throw on top of that?
Ann did the tough part for me, which was kind of listing off all the numbers and the facts. Freddie had a great year as well. I can just cover quickly, what our volume was, but we did 82.5 billion in 2020, and that's up a little bit from 78 in 2019. So we're obviously in the same boat with the same cap, so making similar adjustments. It's same mission goals, deploying the capital effectively, and the optimization of deploying capital is key for us this year with a cap decrease. So similar sentiments to Ann.
Thank you. Don, the life company space, we heard from the agencies. What's the life company appetite in 2021 for multifamily?
Well, I would suggest that we, and you have to take a step back, that we are portfolio lenders as an industry. And as such, we eat what we kill. So we have no formulas. We're looking for good investments in all of the various property types. But I think of it as a kind of like a pizza. So if you only have 5 or 6 different property types you can invest in, and then some of those slices are gone, which includes retail is challenging and office, then there's been more and more emphasis with a flight to quality towards apartments and industrial. So in answer to your question, there's a very healthy appetite for apartments. I would suggest that as an industry and at Protective, we've done a higher volume in that property type than historically given over the years. And I don't anticipate that disrupting, and I see it going further through this entire cycle.
Thanks. So Zach, given the fact the agencies, life companies, et cetera, are all hot to lend on multifamily, how does CMBS compete in this space, or what is your competitive niche in multifamily?
Yeah, I think CMBS competes where it always does, on pricing and leverage, right? Where CMBS does really, really well today is anything that's called mid-60s LTV and lower with full-term IO. The full-term IO works very, very well in the Fitch model. And then this, call it medium to low leverage, also works very, very well. Where we can't compete at all is in the higher leverage. If something's 75 LTV with amortization, we're just not going to be competitive versus the agencies today. Also, certain markets work better too. If you look at CMBS and where where multifamily has been done, it tends to be overwhelmingly New York, California, and Texas. Those 3 states are the top 3 states in CMBS for multifamily every single year. They make up 30 to 40% total in just those 3 states. So I think we're able to be competitive there. We're able to be competitive at this medium leverage and full IO.
Thanks. So those of you who attended this event last year may recall at the end, someone asked a question about the impacts of COVID on lender inspections, et cetera. And I think there was a big chuckle from the crowd. And I made some witty retort about, we'll wear hazmat suits. And yeah, joke was on us. So let's get the 800-pound elephant in the room. Let's get that out on the table and talk about what COVID impacts have had your lending space. I'm going to start with Dawn and then move through the panelists. How is COVID impacting? What special considerations are you?
Well, it's interesting. COVID has impacted every business model, including apartments. And so I'll start with kind of the process. All of our employees, and we're starting to migrate back to the headquarters building with exception to Don, who cut a deal before it was posh to work out of your home. So what we're finding is a couple different things. In the process, we have not been able to corporately travel, and that has impacted our ability to be face-to-face with our partners and mortgage bankers throughout the country. As it comes to site inspections, we do that by third-party vendor. So that's been a little bit of a new twist, and we've been able to adjust to that very rapidly, and it's been seamless. And it's going to be interesting to see how things move forward as the vaccine and markets open up. From the standpoint of actual looking at apartment underwriting, I think that COVID has a huge impact on what had been traditionally a demographic trend towards the urban core, micro apartments, et cetera. And we're seeing a big demographic shift to suburbia, to places like where I live in Western North Carolina. And the residents are looking for bigger units. They're looking for technology that they can work out of their home. They're looking for dedicated workspaces. And I don't necessarily see this trend changing, but that's my view of COVID.
Thanks. So given your virtual background, I can understand the demographic shift to people moving to where you are. Anne, can you weigh in on COVID impacts, please?
Yeah, sure. I mean, just to echo what Don said, obviously we have not been traveling. Like I said, this was my last business trip this time last year. I think it's pretty remarkable that everybody across the country seems like overnight went virtual. So I have to say, leveraging the technology we have in place has really been huge for us. And we, Fannie Mae, we've been able to kind of do it without a hiccup, quite frankly. From kind of an underwriting standpoint and credit standpoint, we did have to make some changes pretty quickly, which we instilled in kind of late March of last year. And we really tried to be very thoughtful in the changes that we made and be very transparent and quick to share that feedback and just, kind of maintain consistency. So I'm sure everybody's heard, we've implemented what we're calling COVID reserves for loans that were originated after that time. Our model is delegated, which means that our lender partners can originate loans on a delegated basis. They don't have to come into us on every single transaction for review. And because of that, we did have to pull back some of our underwriting guides in certain circumstances. For example, in the student housing space, that is, for the most part, there's a lot of aspects to that product that are delegated. And we made those, we wanted to see those transactions, and we changed our appetite on that a little bit during COVID. Also, clearly in the senior housing space, in the small loan space, we've had to make some tweaks. So it's really remarkable how lenders, we all kind of huddled together and people really embraced our changes pretty seamlessly. And we really tried to stay consistent and make adjustments as needed.
Thank you. Sarah, I'm going to add the same question. I mean, from your perspective as a producer, what kind of impacts has COVID had on you?
Well, we
counsel
certainly,
your borrowers.
yeah, really, we've been so lucky because most of our borrowers with multifamily properties stayed pretty steady, didn't have the pain that we were worried about at the beginning of this. A lot of the lenders are doing virtual inspections via Zoom or Facebook or FaceTime on their cell phones or whatever. So they're able to see the units virtually as somebody from our office or a third party or the appraiser or the engineer go through. So that's kind of interesting. And I don't know if that's going to change or not, because every time a lender used to do a deal, they used to come to town and inspect it personally. So I don't know if that's going to change or not. The underwriting, a little tighter with CBD, as you mentioned. It seems like the urban cores are having more trouble in terms of occupancy than the suburbs, of course. But we're also seeing lenders, interestingly enough, because the multifamily space is so competitive, a lot of them are trying to get in early pre-stabilization. We're seeing that a lot more than we used to. So that's something that's going to help our borrowers, because deals that are still in construction, well, finished with construction, but in lease up, we're able to get them financing on, whereas maybe that wasn't as popular of a product earlier.
Okay, I'm going to ask Zach that same question. If you could weigh in on COVID, then we'll go to Griffin, please.
Yeah, I would say that from our side, we took we took what the agencies were doing at the very beginning. So coming right out of the beginning of the COVID crisis, and we added debt service reserves, et cetera. But fast forward to today, we have none of that. And if you look at the type of lending that we're doing, not just in Morgan Stanley, but across the conduit business, in multifamily, it is going to be exactly the same or more aggressive than what was done pre-COVID. The one thing that's probably worth thinking about is concessions, especially in those urban markets. That's the one item that we're still trying to figure out how the agencies are going to underwrite increased concessions. In New York City, for instance, we're routinely seeing, a 15-month lease with 3 months of free rent, and trying to figure out what the agencies will do there is probably the next step in our process.
Thanks. Griffin.
Yeah, a lot of the same as everyone else that the rest of the group's already covered, but we were restricted on travel as well, which is something that I personally really miss, and I know a lot of our team really misses at Freddie. We love getting in front of you all and our Optigo network, and in front of borrowers, and having meetings and really seeing the real estate, because we really pride ourselves on knowing our market. So look forward to hopefully traveling again at some point soon. I'm not sure it's going to go back to the same amount of travel that it was before, but would like to go back and get in our markets at some point soon. Sarah mentioned the virtual inspections. That was something our SBL team actually was already doing on a broad basis. And so that was really easy for our conventional group to adopt, which was great. So that was pretty seamless as well. We added debt service reserves, as was already covered. We're looking at that now, and hopefully in the next couple of weeks, they're going to have some guidance on it, because we're going to have our first release request coming up April 1st. So we want to make sure we're ahead of that. So we're going to put out some guidance, and then we are looking at potential changes to the DSR, friendlier changes, I guess I'll say. So nothing official yet, but look out for that. So we're excited for some potential changes there, because I know everyone in the market would really like some changes there. And then student, Ann covered that. We pulled back a little bit and just were a little bit more conservative there as well. It was a big question mark on whether students were going to come back. Are they going to be required to pay those leases out if they don't take possession of the leases? So I run student nationally for Freddie, so I was waiting a little bit on bated breath to see what happened. It panned out and performed well. And then MHC, we made a few changes this year based on the cap changes, and all the other products. I think it's been pretty much steady as she goes, and obviously had a great year.
Thanks. So the panelists are warmed up. Now we're going to go to a two-part question. This two-part is, let's talk about your underwriting parameter, general underwriting parameters on a multifamily deal, what you're looking for. And the second part of that question is particular attention to how are you underwriting real estate taxes on your analysis. So Zach, if we could start with you, please, and kind of give us your general underwriting parameters and then your thoughts on how you're looking at real estate taxes.
Sure. So I think from general underwriting parameters, we're cash flow lenders. So the debt yield is going to be what's most important to us, more so than the LTV or just the DSCR. In primary markets like New York, LA, San Francisco, we routinely are doing multifamily in the 6-handle debt yields. In smaller, tertiary markets, we could be closer to a 9. Generally speaking, again, the 60 to 67 LTV on an acquisition with full term IO is really what works best for us. I said this earlier, but we seldom can beat agencies at 75 LTV with 30-year amortization. Actually, in general, we don't win with 30-year amortization. We don't do the debt service reserves, et cetera. In terms of how we underwrite and going down, a cash flow, I think another advantage, or at least a difference that we have, is that we can underwrite almost to a T0 on your net rental income, which is probably a little bit different. We don't need history on that. We'll look at the in-place rent roll. We do need some history on other income. We will need, an appraisal to justify the expenses. But in terms of just the income, we can do essentially a T0. In terms of real estate taxes, generally we'll underwrite what our appraiser has. If there is an abatement, we will need to underwrite, for the agencies will be a, excuse me, 15-year average. For Morgan Stanley would be a 10-year average.
Okay. Let's see. Don, would you like to follow up?
Certainly. As I said before, we're Lifeco's our portfolio lenders, and so we don't have fancy formulas that you have to hit. We're looking for both a return on and of capital. And as such, we're not selling the secondary market, and we're just trying to make really, really good underwriting decisions. So to give you a little bit of a framework, by state regulation, every insurance company has a different level that they can lend to, and the band is usually 75 to 80% loan to value. For protective, we've stayed in the 75% loan to value range. You always like to look at, how are you going to fund on a pre-stabilized basis, and so you need to define what is stabilized property. And for us, we're looking for something close to 90% leased and occupied for 1 month. We're not looking for a 90-day or longer period. We have no COVID reserves. We're also not chasing cap rates down to historical lows yet. We're looking for a longer pattern to determine what really is a long-term value proposition. So right now, I would suggest to you that on external appraisals, we're coming in probably between 60 to 65% loan to value. It's real simple. We can do anything that we want to because we're not formulaic, and that if we see a good sight line with a good sponsor, we could structure into a pre-leased or pre-stabilized property if we elect to. We're also have the ability to go short. We have the ability to go long, so 3-year to 5-year or 25-year executions. So we got a lot of tools in our arsenal that we can provide a value proposition to most apartment customers. As it relates to real estate taxes, we're always looking for full taxes. We're not looking to minimize or refine pricing and dollars down to the most lowest denominator based on anything that you may have with TIF financing or any other type of tax incentives that are out there. I hope I answered your question.
Yes, you did. And I'll ask you to follow Don with underwriting points and real estate taxes.
So when you can't do a 75% loan with 30-year AM with Zach, that's when you call Griffin and I, because we can do those deals. We will go up to 80%. Sorry, Zach, we're trying to compliment each other here, see? So we'll go up to 80% on an acquisition, 125 debt service coverage. On cash out refis, we like to be at 75% max leverage. There are a couple markets where we will consider going up to 80% on a cash out refi. That's typically in kind of what, what we call our strong markets, our top markets. So there's a whole kind of little cohort of those spaces. We're also a cash flow lender. We lend on stabilized assets. So depending on the specific property type, generally looking for 85% physical for the past 90 days. In our small loan space, that tightens up a little bit to 90% for 90 days. As far as we generally like to look at a T3, we will consider a T1 on a newer asset or, kind of on a case-by-case basis. I will say, as far as real estate taxes are concerned, we will underwrite an abatement. But if that tax abatement burns off during the loan term, we will account for that in our exit analysis. And so we will look year by year to see how the tax changes or when it increases. And we don't want to ever be really below like a 120, 125. I'm sorry, 120, say even 115 during that life of the loan in any given year. And then we want to make sure that our loan exits appropriately at the maturity. So even though we'll underwrite some abated taxes up front, we might need to adjust the proceeds or maybe some interest only to make sure that we have a solid DSCR during the life of the loan.
Thanks. Griffin, if you'd like to add to that in any fashion.
Yeah, so I think Ann said it well. We're pretty much in line. I mean, and I think she touched on a little bit, but we look at every single deal that comes in at Freddie, and so we're going to take every unique situation into account. And we have our standard credit policy, right? But we do deviate from that in certain situations where we feel it's warranted. We handle tax abatements in a very similar way, I would say, on acquisitions. Based on all the deals we've done, we put together kind of a spreadsheet and we track them after acquisition the next year. Did they get reassessed? So that's what we look at on an acquisition basis, I would say. It's like, did we kind of assume a reassessment, and we go to a percentage based on what we've seen historically in certain markets. So in Texas, for example, in Dallas on a Class A property, we generally see those get reassessed to around 100% of purchase price. So when we're looking at an acquisition in Dallas, we're probably going to underwrite somewhere between 90 and 100% of purchase price. We've even seen over 100%. So on a refi, we'll generally just look at the trailing taxes and apply some sort of inflation factor, based on historicals, maybe 3 to 5% or something like that. So specifically to taxes, that's kind of how we look at it, acquisition versus refi.
Thanks. Well, you mentioned Texas, and I'm going to come to you in a second. There, Texas, a couple of borrowers asked me to mention to you that in Ohio, we're on the federal weatherized power grid. Our chances of going without water and power for a week is kind of low. So just bear in mind when you're doing your underwriting where you want to lend.
Will do.
Okay, I have to talk about real estate taxes because every package we do, that is the focus of our underwriting, because we have to change it depending upon what lender we're sending it to. Because with the agencies, usually we use 80% of value, or we look at tax comps depending, and we raise them up to the highest level of the tax comps. With some life companies, they use 100% no matter what. Other life companies will use tax comps maybe plus 20% or 25%. Sometimes we underwrite a deal 3 different ways depending upon who we're submitting it to. And many times we'll include a pro forma that shows actual taxes, 20% increased taxes, and full taxes, and show the differentiation in what that does to the cap rate. So we spend a lot of time on real estate taxes when we're submitting our deals to the lenders, and we really comp them out, and we really talk to the borrower about it and make sure that they understand what we're doing, why we're doing it, how we're doing it. That just seems to be the most tricky part of every multifamily deal that we're submitting.
Thanks. Good point. Yeah, real estate taxes. Let's talk. Let's take a minute. Just move over to small balance loans. Griffin, if you would define in your space what's a small balance loan, and what's the advantage of using a small loan at Freddie?
Yeah, absolutely. So we define the small balance loans, the SBL program, as 7.5 million and under, and those are generally at 75% leverage, and they're usually kind of 100 units or less. I know that the SBL program can make some exceptions to go over 100 units, but generally we're maxing out at that 7.5. I would say advantages to the SBL program: more streamlined. It's generally cheaper costs. When you talk about legal fees and just overall financing fees, it's a little bit cheaper compared to the conventional program. And there's certain markets where we do see our SBL program get higher leverage than maybe the conventional team would go to. And we generally see that in this maybe secondary, tertiary markets. We'll see the SBL program still hold up to 70 or 75%, whereas maybe the conventional team would be at the 65%. So I would say those are the main advantages that we see at Freddie.
Anne, would you like to add?
Yes, I would, because I run our small loan program nationwide for Fannie Mae. So it is near and dear to my heart. I have for a long time. So, I mean, you know, Griffin really hit it on the head in terms of the advantages. It's a more streamlined execution. It is a cheaper execution from an origination cost standpoint. You know, we do some streamlined third parties. Obviously, the legal lift is a lot lighter. What really, I think, differentiates us is our delegated model, because these small loans have to be really light touch, right? They're kind of like in and out, and you keep the machine going. So our delegated model really makes our small loan program successful, because lenders can control the process. They can, you know, move as quickly as the deal needs to. There are deals we certainly need to look at for price, but it's a very light touch. We like to kind of get them in and out. You know, small loans obviously fills a huge need from an affordability standpoint and from a mission standpoint. And, you know, it's something that's always been important to Fannie Mae. We've been in this space, you know, 20 years, kind of give or take. It's looked very different year over year. You know, and I would say even during COVID, I mentioned at the top of the meeting that we had to make some adjustments, and that was certainly true. Initially, our COVID reserves were a little bit more conservative. In the, you know, we held a little bit higher of a reserve on the small loan deals. And, you know, deals below 3 million, we're kind of keeping that right in the box of what we do in terms of programmatic, you know, underwriting and those types of things.
Thanks. Sarah, anything you'd like to add on small balance loans?
No, they're very easy to process. I'm working on 8 of them right now, and they are definitely streamlined from a reporting standpoint. The forms that need to be required, the third-party reports are modified, the costs are lower. So if the loan is, you know, $7.5 million or below, we really try to process it under the small loan program.
Thanks. Thank you. I see a number of our developer friends on the call today. So when should a developer approach each of you with their project to go to permanent? I'd like to start with, let's go to Zach, if you can tell us when a deal is ripe for you to lend on coming out of new construction.
Sure. So I think it depends on when you think it's going to be leased up. So in the last year, we've done approach this a few different ways. One, we can approach it with a capitalized holdback. So that's if maybe you're going to get to high 80s or even low 90s% during the diligence process for the loan, but you still think you're going to be able to do a little bit more leasing or burning off of concessions, et cetera, within the next year or so. So we can hold that money back and then have it released to you when you achieve certain metrics. The other thing we can just do is step that you'll hit those numbers during the diligence period. And we can even extend that diligence period to 90 days instead of 60 to allow you to hit those metrics. And we routinely do both of those things to help people achieve what they need to in terms of the debt load. And also, again, in fact, we only need really a T0 on the rental income. Excuse me again. Is helpful in that regard.
Thanks. Don, how about you?
Interesting question, and every deal is going to be different. And let me try to explain why I make that comment. And that is, we have several different solutions for people that are coming out of their construction phase and into a permanent loan. As we all know, the sale market is backed up to some degree, and some people tend to be more merchant builders. And so if we're looking to accommodate, for lack of a better description, a bridge financing, we can offer a 3 or 5 year execution And that underwriting is going to look a lot different than what a longer term permanent loan will look like. Generally speaking, we're trying to target somewhere in that 90% range with actual cash in the door. It's all going to be true cash to the bottom line as to where you're going to go with your loan dollars. But by example, I could offer a 3-year loan with a 12-month lockout and open to prepayment at par thereafter at very lucrative pricing, which may be a solution for somebody that's looking for the sales market to come back, and then they can fully execute upon what they believe will be full value. And then I can go to a 25-year fixed rate loan that, you know, we can go to maximum proceeds because there's no interest rate or refinance risk at that point. So there's not a definitive answer other than for kind of getting towards that 90% occupancy period.
I'm going to put a little plug in for Don doing pre-stabilized. We did one this past year that he issued the loan commitment in February for a June 30th funding. And because that was like right when COVID, you know, the early stages of it, and leasing wasn't quite there in June. So he gave a 1-month extension, no fee, to accommodate the borrower. They got to their 90% and he closed. So he was great in working with them to try to get that done during sort of a stressful time.
Thanks.
I might add that we do have the ability to go forward. We will write up to a 12-month forward. Everybody asks, you know, what is that premium? And it's all dependent on the yield curve. Right now, it's kind of averaging 2 basis points for every 30-day period after the first 90.
Thanks. Ann or Griffin, anything you'd like to add on that relative to developers coming to you for perm?
I would just say, like, generally, we try to kind of work backwards, I think, kind of similar to what Zach said. So, you know, tell me when you think you're going to stabilize and you're going to be able to get us close with, we can, you know, rate lock and close with a T1. Then we kind of work backwards from there. So that's how we always kind of approach it when we're talking to our Optigo network or our borrowers. You know, we have a LISA program. I would say we're going to utilize that on a very, very selective basis, just given the changes to the cap. That's something that we utilized a couple of years ago. And then once the cap was instituted, that we kind of had to shift our focus, right? We had to focus on the mission goals. And so generally the newer assets coming out of LISA don't help you achieve those mission goals. So, you know, if you have one of those unique situations, which is kind of what we're focused on with the LISA program, and what I mean by that is maybe where you have some units set aside at a certain percentage of AMI, and that makes it a really mission-rich deal. That's something that we would maybe take a look at. But yeah, I would say overall for the LISA program, very rare. So generally, we're going to be looking to rate lock and close with a T1 collections.
Thanks. Ann, do you have anything to add on Griffin's comments?
You know, not really. We very much so are, you know, a stabilized lender. We do have a near stab execution that we're not really doing much of during COVID for obvious reasons. But we do have it available. We did it in years past where borrowers, you know, that was something that is pre-review by us. So that is not delegated to lenders. We have to review those transactions. And essentially the way that program is structured is it allows a borrower to rate lock at 75% physical occupancy. You underwrite stabilized occupancy, and then you have 120 days to reach stabilization. So it just, there's no collateral between kind of rate lock and stabilization. So we do it, it's a very easy, like very good, clean execution, but we're very selective on when we approve that. So as Griffin said, it's something that is done kind of on a very limited basis. But certainly, you know, we have very strong borrowers that we work with and have a very long track record with, that we're very comfortable with, you know, their operations, their sophistication in a particular market. So it is an execution that has been pretty popular for us in years past, but we've taken a little bit of a pause on it during COVID.
Thanks. Sarah?
Okay, so since you're kind of talking about forwards and pre-stab, I want to get into that a little bit. We're working on quite a few deals. With our life companies, we can go out up to 12 months. Most of them like to stay within 6 to 9, but we are doing a lot of deals where we're locking in now for maturities that are later this year. That is an advantage that the life companies do have. They lock rated application and that rate is held till it's closed. The other thing is we're working on quite a few deals that are at 50% leasing, 60% leasing, where they will commit now for the forward. And as long as the borrowers hit the metrics, they'll fund it, or they can do an extension for a fee or resize it or whatever. That's just, as I said before, that's a product that's quite popular with the rates being so low right now.
Mm-hmm. Yeah, great point. Thank you very much. I'm gonna shout out to our audience that we're running low on our softball questions here. So if you'd like to tee up a few things, send them to us in the chat and we'll be on to you shortly. But in the meantime, let's talk about how you handle an acquisition versus the cash out refi in your underwriting and your treatment. And can you talk about how you handle them differently, or what's your protocol at Fannie?
Yeah, so earlier I mentioned that we will go up to 80% leverage on an acquisition. That's, programmatic for us. We do have certain markets, that maybe we want to be a little bit more conservative on, but programmatically we're at an 80% leverage point on acquisitions, 75% for cash out refis. If it's a rate and term, we would do 80 as well. We really look at the deal with, you've got a lot of fresh equity coming in. So that certainly helps with the structure of the transactions. I mentioned also that we still do have and require COVID reserve escrows. We've recently not made any, programmatic changes, but we have kind of started to consider what we're calling waivers in certain circumstances on acquisition transactions where fresh equity is coming in, with strong borrowers, where you've got a property with stable collections and, just solid operations. So we do give benefit to the fresh equity coming in, but we certainly are not shy to do cash out refis. Certainly after a borrower's owned a property for, 3-4 years, we do a lot of that business as well.
Thank you. Griffin, you want to weigh in on that also?
Yeah, same thing for acquisitions, 81-25. Obviously, love the cash going ahead of you on an acquisition. On the cash out refis, we're at 75% as well right now. Also, we'll consider 80% in some special circumstances. So, open to hearing the story for sure and considering, making that exception to go to 80. I would say in terms of like the underwriting, I touched a little bit on taxes earlier, but just I guess worth covering again, as Sarah knows, it's a hot button. But assuming in Ohio, generally, 60 to 80% of purchase price is probably what we'll do. Very county dependent and city dependent, and where we land in that percentage. But we're going to look to be somewhere in that range for an acquisition, and then for a refi, it's generally going to be whatever in place taxes are plus a little bit of an inflation, maybe again 3 to 5%. And then generally for a refi, we're going to underwrite your T12 expenses. And then generally on an acquisition, we'll give credit to the budget, assuming it's a operator that we know that's got a lot of good experience and is proven out with their portfolio expense comps and the appraisal. So we do give credit there, in most situations to the borrower budget coming in and trying to reduce expenses in some way. And it's a lot easier to prove out with a payroll schedule. I think R&M and G&A is sometimes a little tougher to prove out, but we'll definitely consider that in terms of getting specific in the underwriting.
I just have to say it's very hard to hit the maximum leverage amount that a lot of the lenders will do, 70, 75, 80, when you have to put full real estate taxes in. It typically knocks it down just because it increases it so much over where the taxes are on an acquisition.
Don, you want to weigh in on acquisition versus refi?
Sure. Frankly, I hope that the audience is hearing a theme. And the theme is that most of the other panelists have formulas that they're working towards. Again, the life cos can make straight line business decisions without worrying about these various metrics. And as a result of that, we're looking for a very clear sight line for execution. We can do almost anything that we elect to do. There's really been no differentiation between an acquisition loan and the refi. We particularly are not concerned about cash out. We don't put any limit caps. Again, we're just looking to make sure that we've got a solid asset that is going to perform over the life of the loan, because we're portfolio lenders, we're not selling to the secondary market.
And the main differentiation between the life companies, the agencies, and CMBS is interest only.
Yes. Thank you. By the way, some of the questions are starting to pour in now from the audience, so stand by for those. How about, let's talk mixed use for a second. How is everyone looking at mixed use in multifamily? How's that affecting your lending appetite, your underwriting criteria, et cetera? Zach, how in the CMBS world, do you make a distinction on mixed use versus straight multifamily?
I mean, it's probably an advantage to us over Fannie and Freddie that we don't have any type of cap on how much could be retail as part of a multifamily project. I would say that it impacts our valuation of the property, right? The overall cap rate is probably going to be higher if it has a large percentage of retail. So consequently, we're going to want a higher debt yield on it. We're probably going to need to collect some sort of reserves if it's a high percentage too, in terms of TIs for the retail at the bottom. But does that mean that we're going to have any less appetite? No, not at all.
Mm-hmm. Since Don already told us we're life cos and we can do whatever the heck we want, and I'm going to pose this same question on mixed use to Griffin and Ann. Griffin, if you want to talk about Freddie's approach to mixed use.
Sure. Yeah. You know, we, as a multifamily specific lender, you know, and that's mandated, right? We can do mixed use, but it can only go up to a certain percentage. Otherwise, it's, you know, once you start creeping over 40, 50%, then the question really is this really a multifamily specific project, or is it more of a retail with some multifamily component? So we do a decent amount of mixed use. It's generally, again, less than 40% or less of the income or the square footage, just because we want to really maintain that it is a multifamily project. Otherwise, it can be a charter issue with FHFA. But in terms of the leverage, you know, we don't back off the leverage because it's a mixed use project. We kind of treat it the same way if it was just a normal acquisition or a normal cash out refi. No adjustments there. And then generally, you know, in terms of the underwriting, we did get a little bit more conservative on you know, our retail office portions of those projects during COVID. I think we've definitely loosened back up and are more in line with where we were before. We're generally underwriting, you know, a 10% vacancy on anything that's been open and paying rent during the pandemic. I think, you know, we need to talk about specific situations where maybe somebody, you know, had to take abated rent or something like, or wasn't paying rent for a couple months. You know, we still consider those, and we'll still underwrite the income on those projects. We may just maybe underwrite a little bit more vacancy, but, you know, again, open to discussing any situation.
Mm-hmm. How about you, Ann?
Yeah, I would say I echo a lot of what Griffin shared. I would say we're even probably more conservative, quite frankly. We don't want to be in excess of 35% of the space for commercial. And from an underwriting standpoint, we will only underwrite 20% of that income for all the same reasons. You know, we are multifamily lenders, you know, residential is really what is most important to us. Now, we will make some accommodations. We will consider other scenarios, particularly maybe in urban areas, or certainly if there's some affordability in the residential units where some of those, you know, ratios get a little bit skewed because the rents are a little bit, you know, lower than typical on the residential. But for the most part, we stick to those numbers. And as Griffin mentioned, we are much more cautious during COVID. We focus on the tenant base in terms of who's essential, who's not. In some scenarios, we really haircut the income or potentially not even included it. So it's really case by case during this time.
Sarah, do you have some counsel for your borrowers who have mixed use deals when they come to you? Any tips or tidbits?
Well, I have found that the lenders are a little more conservative. At least they have been up until now. I have a deal right now with first floor retail, and it's been 100% occupied the whole time, and none of the income is being counted, frankly. But it has a grader, so I'm arguing that has to be counted because that's an essential use. Okay. Anyway, in general, the life companies really are pretty open to any kind of mixed use. They'll maybe underwrite the office/retail portion more conservatively, but we have had plenty of success in our office doing mixed use properties.
Thanks. Thank you. Hey, I want to allow some time here for the some of the audience question. And in fact, several of them came in similarly. So I'm going to couch this into one question because yesterday I heard from two different investors the phrase before and after lunch, turbulence in the bond markets, from two different people. And so the questions that are coming up right now, I mean, with the with kind of uptick in movement in the 10-year, I mean, how are you see, you see spreads compressing in the near term? What's your outlook on interest rates and et cetera for the balance of the year? Don, you want to field that one first and then we'll go around the horn?
Absolutely. So obviously there's been a lot of turbulence in the not only the bond market, but the treasury market. And we have to think of this holistically. So just think that we got a pot of money and we can make investments. Where are we going to put our money? Well, we're putting it in all sorts of instruments, including mortgage loans. So we're trying to model out relative value for each and what is your capital charge against each one of those different asset classes. What you're really looking for is more specific to rate. I would suggest to you we've been very bullish in this particular cycle to not necessarily raise rates. Everybody likes to benchmark off the 10-year. Again, we are all over the board, but just to give you some pricing guidance or give you an idea where we have been pricing 10-year money today, we're in that 2.65% to 3% range. So kind of all over the sweet spot, and every deal is going to be priced differently. I would also like to add, and kind of getting ahead of myself, I like to look at commercial mortgage loans holistically. So from the borrower standpoint, it's always easy to price to perfection and get the last dollar and et cetera. But at the end of the day, when the loan is closed, these loans are being serviced locally. You've always got a point of contact to reach out to when you have a problem over horizon of the loan. Again, we're not selling to the secondary market.
Zach, how about you? Pricing, spreads, interest rate projections, all the above?
Sure. Look, historically, spreads and interest rates are inversely correlated, right? So if we look over the past decade plus, we'll generally see that if interest rates start going up, we will see spreads rally. Now, when we look at where CMBS spreads are today, especially at the top of our capital structure, we're actually at post-global financial crisis tights. So I think there's a little bit more resistance for further rally at the top. So unfortunately, what's happened over the last month or month or two is that as interest rates have backed up 40 plus basis points, and I say 40 plus because predominantly our loans are 10-year loans, our coupons have just gone up because we've only been able to rally so much more on the spread side. And I think over the last few weeks, actually, it's made the insurance companies more competitive against our product, as you know, a lot of insurance companies or banks have floors, but now with interest rates higher and our spreads not able to continue to rally quite as much, I think we're less competitive against that product.
Thanks. Ann, any thoughts that you'd like to add?
No, I mean, I can't predict or forecast rates or spreads. If I could, I certainly wouldn't be sitting here for 18 years. But, obviously, treasuries have gone up. The spreads have tightened, the investor spreads. I mean, the spreads are pretty attractive right now for the dust paper. We have a single asset MBS model. So we do go, out to the market, but it is on a loan by loan basis. So spreads, kind of change and we move with the market. We do have our credit fees that we, publish and we monitor on a regular basis just to kind of manage pipeline and make sure we're continuously providing liquidity and capital in the marketplace. As far as kind of ongoing servicing and being able to kind of make our own decisions, just to kind of talk a little bit more based on what Don shared is, with a single asset MBS model and us having lender loss sharing with our partners, our lenders service every single loan that they do. And really it's just them that can make the majority of the decisions. And then if there's something kind of during the life of the loan that creeps up or needs to be addressed or handled, there's some circumstances where they need to come to us, but that's it, right? It's the borrower, it's the lender, and it's us. So it's just three people making that decision. It is not a complicated, kind of secondary market type execution for post-purchase items. So, things have definitely slowed down for us a little bit. And 2020 was so busy. I think everybody's kind of caught their breath a little bit. And we're just watching the rates and, we're staying busy, but the Treasury's definitely widened out, and we are competing with life companies. I'll say that, or trying to.
Griffin, anything to add?
Agree with Ann. We're definitely competing with life cos in certain situations. Obviously, that's mainly on the lower leverage deals. We just actually dropped pricing across the board on the fixed rate side at 10 basis points a couple of weeks ago. So that's, as Ann said, something we're going to continue to monitor, and see kind of how we're doing, right? I mean, it depends how many deals we're signing up, what's our volume looking like, as we're tracking the whole year towards that $70 billion cap, we're going to make adjustments to make sure that we are consistently providing liquidity throughout the year, right? We don't want to start too hot or too cold. We want to make sure that we're really being consistent throughout the year. And that's a big goal of ours at Freddie for 2021. It's just to try and remain as consistent as possible. It's, we're 3 months into the year, which obviously isn't a lot, but for the production side, it's actually more than 3 months because the production season or selling season at Freddie really ends at the end of October. So we're a little further in the year than March 5th right now. We're a couple months ahead. So we feel really good about where we're at for the year in terms of the volume that we've done so far. And, again, we'll continue to keep an eye on spreads just to make sure we maintain that consistent liquidity.
Thanks. So this next question, actually, we'll call this one a jump ball. Okay, it relates to insurance. And so any of your panelists want to answer this as I asked it, just give me a little wave or a signal. This question comes from, well, we won't name them, but curious if the panel could speak to insurance in light of what's been a challenging market, specifically what are changes in deductible requirements, carrier ratings, coverage requirements. Are any dynamics in the insurance market right now impacting your requirements? Anyone have any?
I'll just say real quick that we have a lot of borrowers coming to us because their deductibles have gone way up and they exceed the thresholds that are in their loan documents post-closing. So we're spending a lot of time, well, our servicing group is, not me, but they're going to the different lenders for each borrower and, asking for waivers because really there's almost nothing they can do. If you want them to stay with a carrier of a certain rating, the deductible has just gone up. So we are spending time on insurance post-closing for sure.
Okay, great.
I was going to say the same thing. I agree with Sarah. That's just one thing we've kind of like earmarked as we're looking at deals up front and quoting deals is trying to make sure we bump the insurance a little bit more than we have in the past, just because, we have gotten impacted by that further down the line when we do have the insurance premium. And the tough part about it is usually the insurance premium is something that kind of comes last. So it's always a little bit of a surprise when the insurance premium comes in, the final one, and it's, 20% higher than you thought it would be at quote. So you got to kind of scramble and adjust from there and see what you can do. But it's something we're trying to get a little bit ahead of by just bumping that up a little bit more than we used to. I mean, we used to kind of just generally do like 3% inflation, and now we might do something like 10, just to kind of cover our basis.
Well, anyone else on that topic before I got the next question? Okay, now this question comes in from the Don Dibble fan club. It's actually addressed to Don. In a vertically integrated new mixed-use development, 80%, very specific, 80% multifamily, 20% retail restaurant, assuming the multifamily stabilized, what kind of occupancy would you require for the retail restaurant component?
Well, thank you for the fan club. It's kind of hard to underwrite a project over the phone, but the interesting part is
these are all Tom. We won't hold you this, but just generally speaking. Okay.
Oh yeah, but I'm going to answer this question in an entirely different manner than what you are probably thinking. I look at every transaction holistically, and so I'm not trying to make any political or social statements, but if this project is in Portland, Oregon, there's not a whole lot to talk about. If this is in Lincoln Park, up in the Chicagoland area, I think we have a lot to talk about. And then the next question is going to be, what is the commercial space is it open for business? Has there been COVID relief? What is the sight line for the opportunity for business to open up without any kind of restrictions as it relates to occupancy or seating in the case of the restaurant? So I'm hedging not to give you a specific answer to say that we're going to discount the commercial rate at a certain level or that we're going to discount anything. But the point is really going to be, let's start with where is this property, how is it operating today, and go from there. I feel like I've failed you with a good answer, but that's really the approach that we take.
And I would say to this attendee who asked the question, if you want to direct it directly to Don, you can get his contact information from Sarah if you want to go direct to him on a sidebar. So we have one last audience question, and this one begins, hey Dave, okay, would be curious how the group feels, how about rent growth both in the short term and long term over the duration of the loan? Recognize sizing and closing is backward looking, but is 3% annual rent growth still realistic given market conditions? Well, if that question is to me, I say, heck yeah, 3% rent growth. We model that in our packages all the time. Sometimes we're 4%. But I will ask the lenders on the panel, what are your thoughts? How are you looking at rent growth, both near term and long term? Who wants to open? Zach, would you like to take that one?
Yeah, I would say that I think it's going to be market dependent, which is probably the softball answer. But frankly, we don't ever underwrite any rent growth, right? We're underwriting to sell our loan within 60 days of origination. So there's never a scenario where we're thinking too much about rent growth other than a reset on a ground lease or a tax abatement wearing off, where we're going to need additional cash flow. Those are the only scenarios where we're probably looking at any type of rent growth at all. And in that scenario, we're just looking for what is the minimum, and does that minimum make sense to be able to fund this loan?
Thanks. Griffin or Ann, do you have some thoughts you'd like to weigh in on rent growth or how you look at rent growth?
I mean, I think it's very market specific, right? It's hard to kind of say with a broad brush. Even during COVID, we've seen some markets perform really, really well and maintain really strong rent growth. Others have remained a little bit, flat. So I think, when we generally kind of broad brush approach an exit analysis, we would use like a 2% rent growth and 3% expense growth. But certainly lenders, they analyze what we call an alternative exit. And so they, based on their market knowledge, and they look at data, provided from other industry sources to forecast increased rent, to say like, okay, what would an alternative exit look like? And maybe that might be as a result of the borrower putting in some CapEx to raise rents, right? So every scenario is a little bit different, but generally speaking, broad brush, we would say, we kind of use 2% and then make deviations from there based on the market and the specific scenario.
Yeah, we're pretty much the same at Freddie. We have our what we call our refinance test that we run on every single transaction, just to make sure our exit looks good. And that does take into account rent growth in each and every market. And again, it is very, very market specific. So it's going to change. Some markets obviously much stronger than others. In the actual pro forma, we do not take it into account, similar to what Zach said. We have a similar approach. We're underwriting in place proven income, but it is taken into account in the refi test, and it changes with every market. I think again, some markets 3% year over year, definitely, maybe even higher. Like you said, Dave, maybe 4. But in some markets, it's not as realistic, and you see something maybe like 1.5 to 2.
Hey, Dave, before we close, I just want to again thank these wonderful panelists, and next year, hopefully in person, and wish you a very happy birthday for tomorrow.
Yes. Thanks, Sarah.
Happy birthday.
That's our closing. I guess we're closing. So before we close, you can't hear you because you're all on mute, the attendees, but a big round of applause for Sarah, who puts this esteemed panel together.
Woo! Pleasure.
Great panelists. I want to thank all of our panelists for sharing your thoughts and wisdom with the assembled group today. It's been a lot of great information, and so hopefully when we do this again, we'll be all gathered together, networking over eggs and toast at Kenwood Country Club, perhaps. But in the meantime, thanks. Mark's giving me the signal. Hey, we only paid for this till 9:15.
Yeah.
No, I wanted to thank everybody too, but I did want to give a special shout out to Sarah again for being the sponsor. And then also I would invite you all to come back next March, because she really hosts an incredible breakfast at the Kenwood Country Club. And a special thank you to Michelle Klusman on your screen right here. She's our Director of Communications for the association and put all of this together. She is one of our rock stars on my team, and she just does an incredible job. So thank you all.
Have a great day, everybody.